Today's Talk About It Tuesday question is, should people choose mutual funds or individual stocks? Great question, but in order for me to answer it best, there are two elements of the question that were not mentioned that are very, very important to give the best answer. So the first part that I need to really discuss is, what is the person's investment goal, right? Are we talking about a quick flip where they need to make money in the short term, or are we talking about long term? So in general, when we're talking about investing, I'm going to discuss long term. So I'm thinking a period of 10 years, and we want some type of growth over that 10-year period. So that's our time horizon, 10 years. The second factor that wasn't mentioned is the level of knowledge and skills and experience that a person has, because that is a major factor in determining whether to go with a mutual fund or to go with individual stocks. So if you're talking about individual stocks, it takes a lot of knowledge and experience to be able to properly analyze a company to make a determination as to whether it is a good company to invest for to meet your investment goals over a 10-year period. If you do not have a good knowledge base, a lot of experience, then in general, as a new person, it is not wise for you to invest in individual stocks. There are other factors that might determine, even if you have a little bit of experience, whether or not you should do individual stocks. One thing is the risk factor. If you are not well diversified, meaning you don't have a large portfolio, and I mean at least 10 individual stocks that are uncoupled, meaning they're different sectors or different industries. If you don't have if you can't build a portfolio of at least 10 well diversified individual companies, then it is not a good idea, because you run the risk over that long period of time of losing everything, as opposed to having it well diversified. If you are not willing to constantly rebalance your portfolio, meaning that you're paying attention to financial issues that arise, if you're not interested in looking at your portfolio and watching your companies and see how they're performing, and then making adjustments to either how many stocks you own, or whether you should sell those and put something else in its place. If you're not interested in doing that, then buying individual stocks is not a good idea. So buying individual stocks takes a lot of skill, a lot of experience, a lot of time and attention in order for you to be able to beat the market, because that's what you're trying to do. In order to beat the market, it takes time, effort, skills, and experience. It also takes probably more money in order to diversify enough in order to capitalize, because you have to buy stock in a multitude of companies. So if you don't have a lot of money, don't have a lot of time, don't have a lot of experience, or don't have a lot of interest in maintaining and rebalancing your portfolio, then individual stocks over a long period of time, a long time horizon, is definitely not the answer for most people. So now let's look at the mutual fund option. So we have to understand what a mutual fund is. So a fund company has a diversified portfolio of either stocks, bonds, or other securities, and they pool, that's the mutual part, they pool money, and you buy shares into the fund. Now, there are two types of funds. There are actively managed funds, where they have a fund manager who is in charge of the fund, and their job is to populate the portfolio to be able to beat the market. That's their goal, to be able to beat the market. And they constantly do the work that I told you would do in terms of rebalancing. So they buy some things, sell some things, increase some places, decrease other places, and their goal is to try to beat the market. A passively managed fund is based on what you call an index. So they're usually called index funds. So if it's based on the S&P 500, which is an index, again, that is the market. Actively managed fund tries to beat an index, tries to beat the market. So an index fund based on the S&P 500 would own all 500 companies in the S&P 500. So it's well diversified across, a range of companies. The top performers in the S&P 500 would own them all. And so when we compare over time, if we look at a 10-year horizon, in general, index funds tend to beat the vast majority of actively managed funds over that time period, because an actively managed fund has to constantly rebalance. So when there's rebalancing, there are fees that are attached. So it has a higher tax structure that it has to pay. It has fees for trading that it has to pay. So when you look at the fee structure, in general, an actively managed fund over a long period of time does not beat an index fund. So if you are inexperienced and your goal is to set it and forget it, then you are better off doing a passive, or what you call an index fund, putting your money there, set it and forget it, because that is the market. So when the market is doing extremely well, you'll do extremely well. When it's doing poor, you'll do poor, but it will average out over time. And index funds over a long period of time, 10 years or more, tend to average a 10% return. So for most people, I would say if you're inexperienced and have a long time horizon, don't bother with individual stocks until you get your experience level and your knowledge level up, and you are willing to do the work yourself. And in terms of mutual funds, actively managed funds look super attractive on paper because they can have 60, 70, 80% return, on paper, but when the fees start to kick in, it's much lower, and over a long period of time, they can't maintain that. So there'll be a single year when they have 50, 60, 70%, and then another year where they have a total loss. So over the 10-year period, index funds tend to average out higher than actively managed funds, and definitely better than the inexperienced person trying to beat the market. So hopefully that answered your question. I'd love to hear your strategies. Please like, comment, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.